All right. Good morning and good early afternoon, everybody jumping on here, wherever you are logging in from all over the country. We have federal employees from all 50 states on here and all different agencies. So welcome, welcome. We appreciate you spending some time with us today. And if you've ever been on one of our MyFit University webinars before, you know we go pretty deep into a lot of topics. And this one is a topic that you get one chance to get right. And there's a couple of things I want to make sure that we know how to maximize the three legs of retirement. And I'm going to go deep into all three of them. And I'm going to give you some things I want you to think about today that maybe you either haven't heard of or maybe just a different way of thinking about them. And really, I want to talk about what you can control versus what you can't. And in between that, I'm going to start off today with giving a little bit of strategy to think about, kind of lay the foundation today. And all the three legs of retirement are going to fall into that one strategy. So for those of you that have not attended before, welcome. If this is your first MyFit University webinar, welcome. If you're returning, welcome again. I know we do these pretty regularly, and myself and a lot of other people do these workshops and trainings. This is obviously webinar based. We do live workshops all over the country. If you're in HR, or if you want a live event done anywhere where you live, let us know. We've been going around the country doing live workshops, especially kind of now in this time of a little bit of chaos in the federal world, to say it easily, right? So let's get started here. So a couple disclaimers. Again, I'm going to give basic information today, so please don't take anything that I say and just go and apply it without at least talking to somebody first, unless you're comfortable doing it. And I'm a network representative. My name is Ryan Polimeni. I've been training and teaching federal workshops for over 15 years now, literally all over the United States, crisscrossing the country. It's been a lot of fun. Work with a lot of agencies, do a lot of on-site trainings, do a lot of boot camps, financial planning boot camps. Been a lot of fun. But today, again, basic information, going to go deep into a couple topics, really get you thinking more differently than ever before. You're going to hear me talk taxes. Like I'm not a CPA. I have two that work for me here at our firm. You may hear me talk a little bit about estate planning. I'm not a estate planning attorney, but we're going to hit on the basics. But like I said, all the information today is for general education purposes. Before you start making any changes or taking any advice, please make sure you speak to a professional. We do have network representatives on hand that will answer any question that you have. And I just want to make sure that I'm clear too, because we're doing this live, and we have over 1,000 federal employees, or several thousand actually, on this workshop. We obviously can't take questions live, but at the very end, there's going to be a survey that pops up, and here's what I recommend doing. We will answer every single one of your questions. At the very end, take as many notes as you can throughout the workshop. At the very end, when the survey pops up, it's going to ask you what questions you have. And the more you put in there, the easier it is for us to help you. Now, there's no cost for us helping you. We answer questions for thousands, I mean, literally 100,000 of federal employees every single year. So we're more than happy to help you. But just make sure you take really good notes at the very end when that survey pops up. Go ahead and put those down there. We'll answer your questions for you. Somebody from our team will call you. Okay. MyFit University is one of the largest federal education companies kind of on the planet at this point. Literally trained hundreds of thousands of federal employees over the last couple of years. They have their website. If you have not yet been onto the myfituniversity.com website, highly recommend doing it. You'll be able to go there and get some really good information. Any of these webinars that have been done before will also be on there as a recording, so you can watch a couple different webinars that really help you out there. Okay. Again, they offer free financial planning tools, up-to-date TSP information. Make sure you subscribe, and also too, follow MyFit University on Facebook, on YouTube. A lot of ways to stay in touch with us in different ways, media-wise. Now, at the very end of the workshop, if you request a benefit analysis, I would probably say if you're attending this workshop, you're going to want to get one of these, because one of these benefit analysis, what it does is it breaks down your real numbers. The most important thing is knowing your numbers. We're going to talk about pension today and Social Security and TSP and all those things, but the reality is, without understanding the full picture, and I know right now it's kind of chaotic. I mean, some people are taking, the FERS, some people are retiring early, some people are taking the visa. All these different things that are happening right now are really confusing. And now more than ever, is the time and the opportunity to truly know your numbers and make the best decisions. Look, our phone has been absolutely off the hook in the last 2 months for good reason, obviously. And we have been able, just because we've been in the federal system for so long, to really help a lot of people make the best decisions when it comes to, should I take the early retirement? Should I wait? Should I take my normal retirement? Should I retire early? What should I do? Right? So a couple thousand of you on here probably have the same questions. And that's fine. We want to help that. But first thing first is know your numbers. The benefit report, what it does, it breaks down if you were to retire now versus waiting, seeing what your pension would be now versus delaying your retirement, taking an early retirement. All those things get built into this report that you'll be able to get. So just request that at the end. We'll make sure that we get that over to you. Now, the agenda today is quite a bit. It doesn't look like a lot, but we're going to dive pretty deep, and I'm going to go into a few different things that are really important, because really, as a federal employee, there are three legs to your retirement stool. We call it the three-legged stool of retirement. And if you kick one of those legs off, it's really hard to balance that stool, right? So it's important to get these three legs of retirement right. And as we talk about getting things right, we're going to go through step by step, and I'm going to give you things to focus on versus things you really don't have any control over. And too many people focus on things they don't control, right? So if we're going to get concerned or worry about something, let's worry about the things that we can control. So we're going to talk about the new tax tables for 2025. A lot's changing. There's some things in the distance that could potentially be coming. We're going to review the incomes of retirement, how to maximize the FERS pension. We may have a couple CSRS on here. I'm not going to dive too deep into CSRS today, because we usually don't have a lot, but the FERS pension is going to be important to understand. Oh man, the TSP advantages, the changes, traditional versus Roth, catch up. I'm going to spend probably the majority of our time there today. And the Social Security rules and taxation. I was teaching a TSP and Social Security workshop a couple months ago, and what's really important to understand is the ins and outs rules of Social Security and how it's taxed, because I'm going to share with you shortly how every single one of these stools, these legs to the stool, affect the other. And what I see a lot of mistakes being made is all three of them not working in harmony in your financial plan. And it's really important that you get them right, because those three things working in harmony together will allow you to have a healthy, successful retirement. And again, after doing this now for 15 years, I'm just telling you, I've seen a lot of mistakes. So what I want to do today is kind of steer you around a lot of the potholes other people have ran into, so you don't bust that same tire that a lot of other people have popped along the way, right? So I want to make sure that we're going through and you're understanding piece by piece. Now, let's take a look at the new tax brackets. So what happened was we got a little bit more distance between each one of these tax brackets. And I want to tell you, and I know it doesn't seem like it, but taxes are actually on sale. I know it doesn't feel like that a lot of times, but truthfully, we've been in the lowest tax environment I think we've ever been in. And I run a tax firm. I run a tax and wealth management firm here in Raleigh, North Carolina. And after doing over 3,000 tax prepares and planning with clients all over the country, this is the most important foundational piece that I think a lot of people miss. And if you're taking notes, what I would tell you to do is write this down, because it's really important when it comes to foundational planning for everything else that, income related or asset related. This is important. So I would write this down. The foundation, so the foundation of every financial plan is taxes. I'll say that again. The foundation of every financial plan is taxes. And the reason that I say that is because, again, after running a tax firm for over a decade, I don't know how to make financial planning decisions without every decision being based on the foundation of taxes. And I see that's where a lot of people go wrong, especially in their later years into retirement, which I'm going to share with you some of the pitfalls there. But this is so important. It's understanding where you are today versus where you could be. And I'm going to give you a stat. Most of you have gone through your working career, and if you're just getting started, maybe you've heard this, with this notion that actually isn't true, that when I retire, I'm going to be in a lower tax bracket than when I'm working. For some of you, that may be true. However, what we have found after a decade of tax planning is 64% of our federal clients are in the same tax bracket when they retire than they are when they're working. 64%. And the reason being is because unlike the private sector, you have a pension, you have Social Security, you have two fixed income sources that most people only have one. And then you also have this thing called TSP, right? Where you can also create another income from, or whether you need the money or not, you're going to be forced to have to take money from it at some point. And that creates a third income stream. And that's what keeps most people in the same tax bracket. So I want to make sure that we hit that today because, again, this is a tax planning webinar that we talked about too, that we're going to hit on. And these tax pieces are important. So when you look at these tax brackets, you need to find where you are, right? So look here, if you're on the left is the single taxable income. So if you're a single filer, even I think head of household pretty much goes neck and neck with this. Look at where you fall based on your salary, based on your income sources. Most people are between a 22 and 24% tax bracket. That's both singled, and that middle column is married filing jointly. So if you're married, most of you fall between that 22 to 24% tax bracket. And it's really important because think about the distance between where the 22 starts and where the 24 ends. Let me give you an example. If you're married and you file jointly, the 22% federal tax bracket, I'm talking Fed, this is not state, right? The 22% federal tax bracket starts at $96,951. The 24 ends all the way at $394,000. I mean, you're talking about almost $300,000 of room from the 22 to the 24. And why is that important? Because for a lot of you, tax planning becomes really important in your later years. You may want to do things like Roth conversions, which I'm going to talk a lot about shortly. And the more room you have, the more tax planning opportunities you have to lower your tax liabilities later. Because we know today that if taxes are on sale, let's take advantage of those things, right? And let's do some planning now to set ourselves up for a more tax-free retirement in the future. A lot of you that are attending this, you're not really too heavy in the Roth. Most people that we work with, especially in the million plus range, are predominantly in the traditional, meaning the pre-tax deferred, which all that becomes a taxable income, which I'm going to explain later as we go. But I really want you to focus on this tax bracket, find where you are, because on this next slide, let's talk about what's taxable. Again, this is foundational planning right here because all things that we're going to talk about fall into one of these buckets, right? And the most important thing, whether you're getting ready to retire, think about retiring early, a couple of years from retirement, it does not matter. It is understanding where the taxation is going to occur in your retirement year. So if you are going to receive a FERS or CSRS pension, actually it's referred to as an annuity, then that's going to be fully taxable. That's going to be fully taxable at ordinary income tax. And the reason they refer to it as an annuity, so actually let me rephrase this. When you retire to the federal government, you are referred to as a federal annuitant. And you're referred to as an annuitant, not a pension earner, right? It's an annuitant because an annuity is from the government, is an income that's going to provide you an income for the rest of your life you can never outlive. That's what an annuity is, what an annuity does. It provides you an income forever. You traded a portion of your paycheck, right? That 0.8% of your paycheck every single pay period of your entire working career to receive an income that you can never outlive. That's what an annuity is. It's an exchange. That's why you're referred to as an annuitant. So for those of you that, I've heard annuities and you don't really like them, understand you are an annuitant because that's what it is. It's an exchange. So you have that FERS annuity, and that FERS annuity is fully taxable at ordinary income tax, the tax brackets we just went over. Then you have a TSP and maybe an IRA distribution, or maybe even old 401k, 403b, 457. All of those things that are traditional are taxed as ordinary income tax. So every single penny that comes out of your TSP traditional account is taxed at ordinary income tax. Very, very important to know because you need to add that into the equation. Now, the last piece here is Social Security. Now, I would say for most people in the private sector, that's their largest fixed income stream. For some of you, depending on how long you've been in the federal system, Social Security may actually be your largest fixed income. That's why it's really important to make sure that we get that right and try not to make too many mistakes with there. Because Social Security, there are changes that have been proposed in Congress, not in effect yet. So I'm not going to talk about things that could be, but talk about what's going on now. Social Security is and potentially could be taxable. Depends on how much you make. It depends on those other two buckets. That's why I said, remember what I said, all three of these buckets have to work in harmony with each other. Because if you don't account for one, or you didn't know a certain aspect about one, it could mess up the other two. So let me give you an example. Social Security is taxed based on the amount of income you have from other sources. I'm going to show you how to calculate that in a little bit. But just for conversation's sake, Social Security is taxable based on your income sources. So for example, if your pension is a fully taxable income to you, your TSP distributions is a fully taxable income to you. Social Security has limits to how much you can make before you start getting taxed on your Social Security. Don't you want to know those limits? Of course you would want to know that, because if you don't know the Social Security limit and you say, you know what, just give me 20 grand a year from Social Security or from TSP. But what if the maximum you could take from TSP was 15 grand before you start getting taxed on Social Security? But you didn't know that. And you're taking out 20, and that extra 5,000 puts you in a situation where 85% of your Social Security is now going to go on your tax return as a taxable income. But you didn't withhold any tax on your Social Security. Imagine that tax bill that you didn't know was coming. You see, that plays such a big role, and vice versa. Knowing how much tax on your Social Security and knowing how your first pension plays a big role for your TSP distributions, right? All three things working in harmony. These are the three-legged stool of your federal retirement, and they all work together. And again, I'm going to steer around the potholes a lot of people ran into. This is one of the biggest common mistakes that people make, is not understanding the taxation on all three of these buckets and how they work in harmony with each other. So let me give you a strategy that's gonna help you kind of divide these things out. And what I'm gonna share with you is a little bit different from this thing that you hear, like being a diversified portfolio, right? I'm not gonna get into that. I'm not, that's not what today's topic conversation is. But it's how to, what we call, earmark dollars to perform certain things. And this is where a lot of people, they just don't have a complete plan. You see this a lot, and I want to share this, called a three bucket strategy. This is really important because this is where you start dividing monies that you have, assets that you've accumulated, to then begin separating them. So while you're working, you're in this phase called the accumulation phase, right? And that's so important. You're accumulating all this money. You're socking away money in TSP, IRAs, Roth IRAs, wherever you can put it, right? Savings accounts, and you're doing that for the purpose to live off of that money for the most part, forever, and never run out of money, right? That's the goal. But then you enter this phase, whether you're being phased out, you're rift, whether you're taking the VAR, whether you're retiring normally, whatever the situation is, you find yourself in a situation now where you enter what's called the distribution phase of your life. And this is equally as important, because the distribution phase is everything you work so hard for, during your career as a federal employee, to now begin to separate and start living off of what you worked hard for. So let's start talking about how to separate the three-legged stool. And then I'm going to dive into each one of those a little bit, deeper. Bucket number one is called your income bucket. Now, what's going to go in that income bucket? Well, you're going to have your FERS annuity. You're going to have your Social Security, right? We know those are two fixed incomes. But let's just say, for conversation's sake right now, that you've done a phenomenal job and you've accumulated $500,000 in your TSP. The next question is going to be, now what do I do with it, right? And how do I distribute that to myself in the most tax efficient way? Because you can do it in a very non-tax efficient way. I've seen a lot of mistakes made there. Or you can do it in a way where all these things, remember, these buckets, work in harmony with each other. So I'm going to give you an example, and I'm going to make up numbers. So bear with me for just example and conversation's sake, let's say that you said, Ryan, I need to have $5,000 a month coming in income to pay my bills in retirement. Great. Let's start there. Let's start on that income bucket, and let's say for conversation's sake that your FERS annuity was going to give you a net $2,000 a month, right? So that's 2 grand coming from your FERS annuity. And let's say that your Social Security is going to give you another $2,000. Perfect. We know that in that income bucket that we have 2 fixed incomes that are going to give us 4,000 a month. Got it. Now we need 5, so we're $1,000 a month short from getting to where we want to be. And I would obviously argue with you that if you need $5,000 a month in income in retirement, you want to shoot for 5,500 or 6,000 because life happens, right? The tire blows on the car, the roof leaks, whatever happens. Christmas happens, right? It gets expensive. So you want to be shooting for a little bit more. So let's say that we said, you know what, 5,000 is good, but we want to get to 6,000 a month to live really comfortably. Great. We've got a $2,000 a month income gap between 4 grand in fixed incomes and the 6,000 we'd like to get to. So in that income bucket, out of your $500,000 you did a great job accumulating in TSP, we've got to figure out how much of this 500,000 has got to be earmarked for the purpose of creating an income that we can never outlive. And there's different ways to do that. I'm not going to get into that today, but there are different strategies for doing that. But I'm going to make up a number. Let's say that it's going to take us $200,000 to create $2,000 a month forever, right? So we've got 200 grand that we earmarked for the purpose of income. And we're going to put that into our income bucket, and we're going to draw down that $2,000 a month. So now we've got 6 grand. Life is good and our income bucket is full, but we still have $300,000 left. Well, that's where you start dividing that up. You go, okay, cool. How much money do I want to take risk with, right? Out of my 300 grand, if the market continues like it is right now, for the love of God, not only do you have craziness going on in the federal world, but now you also have this volatile market that's going up and down and scaring the heck out of everybody. So the question is how much money do I want to risk in retirement? Now, this is a lot of fun because I've had, we have clients that are, 20 that take all the risk in the world, which you should be, and we have clients that are 75 that are pedal to the metal in the market. It's up to you, but that's where you figure out how much of this money, out of this 300 grand that I have left that I don't need for income, how much does that I want to take a risk with? Let's say that we're going to put $100,000 of that into our long-term growth, that bucket all the way on the right, that long-term growth bucket. And then we're going to put the other 200 grand in that middle bucket. We're going to be a little bit more conservative with it. We want that money to be there. We don't want to take a lot of risk. That's our emergency money. And maybe that's even our Roth conversion money that we're going to just convert to a Roth so that that's there. But that's how you begin to think about the distribution phase of your life when you're really maximizing these 3-legged stools of your retirement is where's the money going to go? How am I going to separate it? And how am I going to do this in the most tax efficient way? But it begins by in your strategy, understanding where it's going to go and how it's going to be distributed. And I got to tell you, this is where a lot of mistakes are made. And most people don't actually sit down. This is different than a diversified portfolio, right? This is not, I got some stocks here, some bonds here. It's earmarking dollars to perform certain things that you're okay with and comfortable with. So I wanted to hit on that because this is really important foundational planning here as we get into the other pieces. Now, let's talk about some of the advantages of TSP. So the regular contribution limit for 2025, now this is, when I say regular, this is anybody, under the age of 50, and then even at over 50, but when you get over 50, you have a couple other options here. So the regular contribution limit is 23,500 this year. Now, if you are over the age of 50, you can do an additional 7,500 total catch-up, okay? That brings you up to $31,000 if you're over the age of 50. That's a lot of money to be able to put away. So you're up to over $31,000. Now, what a lot of people don't know is there is a special catch-up contribution for participants if you are age 60 through 63. If you're under 60 or over 63, you can't participate in it, which is strange that they do it this way, but you can't. So if you are between 60 and 63, you can do an additional $11,250. So really what it comes down to is if you're 60 to 63, you could do $34,750 with a special contribution. So another little boost to be able to really maximize these things, which is nice. You want to take advantage of everything that you possibly can. Okay. So if you are obviously putting in at least 5%, you're going to get matching dollar for dollar up to the first 5%. Anything over that is your personal contributions. You're not going to get matched. So the first 5% is really important. Now, a big question that I get a lot is, well, what if I am in the Roth TSP? Do I still get matching contributions? The answer is yes, but the matching contributions go into the traditional TSP, which we'll talk more about as we go, okay? Now, I also want to make sure that I'm clear, because this is confusing for people. The 23,500 or 31,000 if you're doing the catch-up, that is a total between the Roth and the traditional. It is not 31,000 in Roth, 31,000 in traditional. It is the combination of the two. You could have, half of that going in traditional, half of that going in Roth. It just has to equal 31,000. Okay, so you can take advantage of both, but it's got to still be in the 31,000. Now, traditional TSP is what a lot of people are in. And what the traditional TSP is your pre-tax contribution. So think about this. Every paycheck that you get, most of you are sending money to TSP. And what does that mean? You're doing that on a pre-tax, tax-deferred basis. So you're getting your paycheck, and before you pay tax on that money, some of that money is going to TSP. You are deferring all of those taxes to a later date, but there's an advantage to doing it while you're working. While you're working, when you are using traditional TSP, you are lowering your tax liabilities today. Let me give you an example. If you make $100,000 and you're putting $10,000 into your TSP, you are actually being taxed on $90,000, not the whole 100. So a traditional TSP allows you to lower your tax liabilities, and for some of you, that's keeping you in a lower tax bracket. For some of you, it makes absolutely no difference, and you maybe take more advantage of Roth, which I'm going to talk about. But remember, all matching contributions go in this. But because all this is tax deferred, going back to the buckets we were talking about before, that TSP distribution bucket, every single penny that you take out of that is 100% taxable. So you've got to add that into the equation and know your limits on the different tax brackets, okay? Now, on the flip side of this, we have this thing called Roth. And this is one of the golden nuggets of retirement, because what's happening now is you get your paycheck, you pay all the taxes, and then the money goes into Roth TSP. And what does that mean? That means that all the money you put in there, including all the gains and interest over your working career, as long as you have had this money in a Roth account for 5 years minimally, every single penny that comes out of that Roth account is 100% tax-free. We call that tax-free retirement. Great opportunity. Same thing. You can put up to $31,000 if you're doing a catch-up into the Roth TSP. Let me tell you why that is incredibly important. If you went to XYZ Financial Corporation down the street and you said, hey, my name is Ryan, I'd like to open up a Roth IRA. They're going to say, great. How much money do you want to put in there? You say, well, at work in my TSP, I can put in 31,000 because I'm over the age of 50. I want to do that. They're going to say, well, sorry. The most you can do is 8,000 in a Roth IRA on the outside in the private sector. So before you go private, I would take advantage of what's here. I see a lot of people doing, $10,000 into the Roth TSP and $8,000 into a Roth IRA, and that's fine. Not putting all your eggs in one basket. I get that, but I would say try to take advantage of what's in front of you as much as possible, because for some of you on the private sector Roth, you're going to max out because of your income, meaning you can't even participate in a Roth IRA. So take advantage of what's in front of you, because there is no income limitation on the Roth TSP. So you can make 400 grand a year and still take advantage of the Roth TSP. A very, very big opportunity for a lot of you to take advantage of that most people don't. Okay. Now, the TSP catch up, again, I went on this. I want to give you a word of caution. When you do the catch up contributions to TSP, make sure that you divide it over a 26 pay period layout. Because if you say, cool, I'm going to do 7,500 over the next 6 months, it's not going to do you any good. I'll give you an example. I was teaching a workshop for one of the VA hospitals in Virginia, and I had a doctor come up to me and he said, Ryan, it's September and I'm no longer getting my matching contributions. What's going on? He had maxed out his total contributions by September, and that point forward, there was no more matching. So you get matching contributions based on a 26 pay period. So anything you do from a catch-up perspective, make sure you do it over a 26 pay period timeline, okay? Just a quick word of caution there. Now, some of you may be going, all right, I like this Roth idea. How do I know if it's right for me or not? So if you and I were sitting down right now across the table from each other or doing a virtual meeting, and you said, Ryan, I really need to understand if I should be doing Roth because I don't know if I'm going to be able to take advantage of it or not. And so what we would do is we would sit down and I would go over dollar by dollar with you. So let's take a single employee, and when I say single, I mean somebody who files single. And let's say that they're making $70,000 a year gross salary. Well, the IRS standard deduction, kind of the gift the IRS gives us this year, is $15,000 for a single filer. So if you look to the brackets right there, you see that they've now gone from $70,000 to $55,000 of taxable income. Well, that's still inside the 22% tax bracket, the federal tax bracket, because right, it's 48 grand to 103. So you still have a little bit of ways to go. But let's say you contributed that $10,000 to your traditional TSP. Remember I told you, those contributions lower your tax liabilities. So now you took $10,000 and put it into your traditional TSP, lowered your tax liability. So now at the adjusted gross taxable income, when you go to file your taxes, you went from 70 grand to a $45,000 taxable income. What did you just do? You brought yourself from a 22 all the way down to a 12% tax bracket. That's a huge savings because now that $45,000 falls in that $11,000 to $48,000 tax bracket. So you've done yourself a favor by using the traditional to lower your tax liabilities. But if you see here, there's still $3,000 of wiggle room before you go back to a 22. So what that says is, hey, I could take $7,000, put it in my traditional TSP, still go from a 22% down to a 12% tax bracket, and still put the other $3,000 into Roth. I can now get the best of all worlds. I can lower my tax liabilities today, but still take advantage of the Roth at the same time. You see, this is why you got to work the numbers, because these are things that a lot of people don't know. You could have said, you know what, I love the Roth. I'm going all in on this Roth thing. And what would you have done? You would have stuck yourself in a 22% tax bracket without getting yourself down to a 12. It cost you 10% to go into the Roth, where you could actually take advantage of both of them. So knowing your, as I started today by saying, know your numbers, because it's how you make the best decisions when you know your numbers that are possible. Okay. Now, I'm going to dive into something a little bit advanced right now. So bear with me as we go. This right here, because of the taxes being as low as they've ever been, this is something that I think pretty much anybody, and I'm going to give a number. It doesn't mean that this is where you have to start, but Roth conversions start making sense if you have 400,000 or more in traditional assets. So if you have 400 grand or more, Roth conversions make sense. Now, why? Because what's a Roth conversion? A Roth conversion is when you take money from your traditional TSP or any traditional IRAs or 403Bs, whatever you have, and you convert that money to a Roth IRA. So you're taking traditional money and converting it to a Roth IRA. Now, there's a lot that goes into that. Roth conversions cannot be done inside TSP yet. So what does that mean? You can't take your traditional TSP and say, man, that Roth thing is great. Let's move all of my money from traditional TSP to a Roth TSP. You cannot do that. Next year, you will be able to do that. But again, you do not want to do that all in one shot, because you could literally lose, a fourth of your or a third of your retirement in one shot by doing that. Here's the other issue. If you do a Roth conversion inside TSP, the taxes on that cannot be withheld. That means that you have to pay the tax out of pocket. So if you converted $100,000 from traditional to Roth and you were supposed to withhold 20 grand, you cannot withhold that. You have to pay that 20,000 out of pocket. It's one of those things that not really, people are not going to be really excited about doing a Roth conversion inside TSP. It's great that they have that option. I just don't see many people doing it. A lot of people who are going to do a Roth conversion do it on the private sector, because when you do this, it does require a deep level of tax planning, because you're not going to do a Roth conversion in one shot. You're going to take, if you got 500,000 or $1,000,000, you're going to really want to take that money and convert a little bit of it. And we have indicators and we have software that shows how to do it. But you're going to want to, you say, I've got this $1,000,000, and over the next 10 years, I'm going to convert $100,000 a year. Why? Because you want to also try to stay in the lowest tax bracket, maybe even the same one, while you do those conversions. And if you're doing it on an outside IRA, you can withhold the taxes, so you have to pay it out of pocket. So again, this is why I said at the very beginning, this is general information. A lot of you are going to really need help if you're going to do this, because there's a lot that goes into that, a lot of rules and regulations around these things. But here's what I would say. If Roth conversions make sense to you and you think it's something you want to explore, when the survey pops up at the end, put that in the notes, because we've got an entire tax team that can at least kind of walk you through what that looks like and give you some guidance as to, hey, listen, this may not be right for you, or maybe the best thing since sliced bread. But why would you want to do a Roth conversion to begin with? Roth conversions are important because for two reasons. Number one, probably more than two reasons, but I'll give you the top two. Estate planning. If you die and you have $500,000 in a traditional TSP, whoever is the beneficiary of that $500,000 is fully liable for the taxes, whether that's your kids, your spouse, whoever, a family member, they are liable for all the taxes on that traditional. If you die and you pass a Roth IRA on to your family, whoever's the beneficiary receives that money tax-free, just like you would be receiving it tax-free as you take distributions, right? Really important. Now, while you're alive and well, if you do this conversion and now you start to take money from it, every single penny of that money is now tax-free. But one of the biggest reasons you do a Roth conversion is because at age 73 or 75, there's this looming tax bomb out there called the required minimum distribution. And what happens with that is the IRS is going to knock on your door and they're going to tell you how much you have to take out of your TSP or IRA. And for a lot of people, they're going to force you to take more than what you need to live on. And in that situation, that could bump you to the next tax bracket. That might be the difference between you going from a 12 to a 24% tax bracket, and there's nothing you can do about it. So Roth conversions plays a really big role, okay? And again, if that's something of interest to you, please put that in the survey. We got some great people that can help you with that, and just at least give you some advice on what to do and if it makes sense or not. And I'll show you with the software that gets used later on as we go. But let's talk about pensions for a second here. So that was a quick overview of TSP. I know I could do another 2-hour workshop just on that, but I want to hit on this because it's important. Maximizing your pension is done by really doing two things: making more money and working longer. That's really it. I hate to break it to you. You cannot call up OPM and go, hey, I would love to put more money into the pension system so I can get more later. They're going to say it's not how it works, right? So as a federal employee, what happens is when you get hired, I'm going to show you the minimum retirement age in a second. When you get hired as a FERS member, 0.8% of your paycheck is going into the FERS system. And most of it's just to keep the payments for everybody else alive right now. If you're a FERS Ray or FERS Fray, meaning you started after 2013 or 2014, you're contributing more, but you're not going to get any more from it. You're just helping keep this thing alive longer. But 6.2% of your paycheck is going to Social Security. That's what you're paying into Social Security. Now, if you're a CSRS member, well, you're not contributing to Social Security, but 7% of your paycheck's going to CSRS annuity, and that's, you can get up to 85% of your paycheck, what you made during your working years as a CSRS member. Very big, but most CSRS members do not get Social Security. So again, as a FERS member, you not only get an annuity from the government, you also get Social Security because you paid into it. So what's the minimum retirement age? So if you look at this chart, this is really important because a lot of you have been asking, should I take the early retirement? How's that going to affect me? And this is where these numbers come down to, because the minimum retirement age for a full retirement, the earliest you could retire, this is like your MRA plus 30 or your MRA plus 10, minimum retirement age plus one of those. But let's say that you met the 30 years of minimum retirement age. This is when you can retire. So age 57, you could retire with 30 years of federal service. That's the earliest you retire. Or you could be, if you were born in 1965, right, and you have 30 years of credible service, that's the earliest you could retire. So that's a good thing. Now, there are 3 ways as a FERS member to retire. One is your MRA plus 30, which we just looked at. Be age 60 with 20 years of service. So as long as you reach age 60 and you have at least 20 years of service, you can retire from the federal government without a reduction in pay. Or reach the age 62 and just have a minimum of 5 years of credible service. Now, what happens if I don't meet any of those? Well, if you don't meet any of them, then there's a 5% pension reduction. I'm going to give you the example here shortly of that, but there's a 5% reduction up to age 62. Now, if you meet the criteria, either MRA plus 30 or 60 with 20 years of credible service, and you have not reached the age of 62 yet. So let's say that today you're 60 years old and you met the 20 years, you say, I'm going to retire today. Not only do you get your annuity from the government, you also get a special supplement. They call it the Social Security supplement. And the reason that is, it doesn't come from Social Security, but the reason they call it that is because it's based on your Social Security's earnings history. Okay. And that supplement stays in place to age 62. And after 62, that drops off because then you're eligible for the first time for Social Security. So again, really important to know, because I'm going to tell you, some people that wanted to retire early doesn't know that they were going to get this. If they just worked 2 more months, they would have got this on top of their FERS instead of walking away early and not getting the supplement. So knowing the rules, especially around this time right now where, the early outs, the RIFs, the VER, all these things that are floating around out there, to make the best decision. Now, let's talk about how to calculate your pension. This might be basic for a lot of you, so if it is, forgive me, but for some of you, if you don't know how to calculate, let's break this down so you know. Your first pension is your high 3 times your credible years of service, then it's times a multiplier. So what does that mean? The multiplier can either be 1% or it could be 1.1. And in order to get the 1.1, the extra 10% in your pension, you have to be age 62 with a minimum of 20 years of credible service. So 62 and 20 will get you an extra 10%. So let's look at the example of this federal employee. This federal employee had a high 3, meaning their highest 3 years of earnings, right, of $100,000. And they had 30 years of credible service. Now, I know there's some things floating around there about the high 5 and all that. I'm talking about what's today. So if you take 100,000, you multiply it by 30, you get 3 million. Then you have to take that 3 million and multiply it by either the 1% or the 1.1. Now, clearly, this person is age 62 and they had 30 years, so they met that multiplier of 1.1. So you do that, and they get $33,000 per year as a gross unreduced annuity. Now, unreduced is important, or it equals $2,750 per month in an unreduced annuity. Unreduced is important. You got to understand what that means. That means that these are the numbers that is before taxes come out of it, both state and federal, depending on if you live in a state with state, right? But definitely federal. Survivorship could either be 5% or 10%, depending if you take a survivorship, whether full or half, right? Health insurance, life insurance, and even sometimes long-term care. But those are the things that are going to come out of your pension check. So you go, woohoo, $2,750 looks great per month, but at the end of the day, that might be $1,500. And you've got to account for that, because remember, going back to our income bucket, you may need that $5,000 a month, and you see, wow, $2,750, I'm more than halfway there. Well, it's actually $1,500. You got a lot more to go. So now you got to calculate how much more to take out of your, TSP to live on. I also want to talk about real quick, when we talk about income and we talk about taking distributions from your TSP, the reason that's important to do what I call earmarking dollars is because I want to give you a scenario here. Think about, you've got this pension coming in, and you're going to take out a certain amount of money from TSP to live on forever, and you need that money to last you forever. Well, some of you say, well, I'm gonna follow the 4 or 5% rule of retirement, where I'm just gonna take out and live off the interest. Sounds great in theory, but this year the market could be in that negative 15 to 20% territory if we keep going in the direction we're going in right now. So what if you were taking out 5% of your TSP every year to live on? And in theory, great, that's just the interest. But then we have a year like right now where, what if we went negative 20 this year? So you're taking out 5, but you lost 20% in the market as well. Now, in that year, you have now taken and lost 25% of your TSP in 1 year. My question to you is, how many years can you do that and sustain that before you start getting worried about running out of money? The reason I ask that question is because a lot of people, that's what's going to happen, is don't underestimate how much money you actually have to take to live on, to net. And if you're going to take out a certain amount of money, let's say you have to take out 5% every single year to live on. Well, that also is going to come with some risk, because that 5%, if that's in the market and you're going to take that risk, you may lose money as well. That's got to be accounted for. So again, think about ways. There are different ways to create incomes forever you can never run out of, but I want you to think about that situation. How many years can you afford to go through years like we're going to have this year, right? And what if we had this kind of year, a market correction or a recession for 2 consecutive years, and we're negative 20 2 years in a row? That's a huge hit while you're also taking income. Just want to put that out there, because as we talk about income and pensions, those are things to really consider. Now, early retirement option, I'm going to dive. This is if you just decided to walk away, okay? So let's say that you're 57, and this is Jason. He's our example. Jason had 19 years of credible service, and he's age 57. So he doesn't meet anything. He didn't meet the MRA plus 30. He didn't meet the 60-20, right? He didn't even meet the 62-5. But he just says, I'm done with this. So again, his calculation in this example, he would get a benefit of $19,000 per year based on his years of service times 1%, leaving early. But what happens is, if he left at age 57 and didn't meet any of the criteria, there would be a 5% reduction in his pension check until 62 forever. So he would lose 25% of that 1,583, and that would bring his pension down to 1,187 a month, because he didn't meet any of the normal criteria for full retirement. So because you left early, you said, I'm all done with the federal government, I don't even care, just give me money, right? That's possible to do. Just understand it's 5% every year to 62, and that's forever. You can never get that money back. So important to understand. Now, again, in the situation where you meet your MRA plus 10, you have 10 years, you know, you can do that and you can retire in a situation like this and still get some pension. I'm not going to get too deep in all that stuff, but these are just different ways. You could also be age 60 with 22 years, retire, get it, and also be eligible for the supplement. You can also postpone your retirement. That's another way of doing it is, maybe you have, a certain amount of years of credible service, but you haven't met age 60. Let's say you have 20 years of credible service, but you're 57 years old. You could postpone your retirement and then start at a later time and get your full retirement. Again, I'm not going to get too deep into that. That's a whole nother topic, but there are ways to do that. So the reason I bring this up is if you're in the middle place right now where do I take the early retirement? Should I retire? I don't know. Put that down on the survey and let's talk about it. Let us give you the guidance you need on that because we're going to run these different scenarios and figure out what's right for you. All right, now VERA versus VSIP. I'm gonna briefly go through this because some agencies are eligible, some are not, right? Some of you are, some of you are not. But the VERA is based on if you're age 50 and you have at least 20 years of service, you can take the VERA. Or if you have 25 years of service, you can be at any age. Your health benefits will stay intact as long as they've been in place for the last 5 years, okay? The supplement is available as well once your MRA is met, your minimum retirement age is met. The VSIP is this kind of new thing that's floating around out there where kind of the same thing as above, but they'll offer you $25,000 payment to voluntarily separate, meaning you could separate, get the $25,000 lump sum out, and still get your benefits. Now, again, there's thousands of people on this call. I don't know where you fall, what things are going to be right for you. I have no idea. But if this is something you're contemplating, and we've taken thousands of these calls over the last month, let us help you. Put it on the survey. Let us know if this is one you want to talk about. We'll run the numbers, see what makes sense. Because like $25,000 lump sum sounds great, but for some people, it actually hurts them to take that if they just wait a little bit longer. Okay. You can go to opm.gov to get a lot of the information on that as well. All right. Lastly, I want to talk about Social Security. This is really important because for a lot of you, again, it's maybe your largest or at least your second largest fixed income. Now, how do you qualify for Social Security is based on getting credits. And to get a credit, you have to make $1,810. Now, you get 4 credits per year. So really, as long as you make $7,240 in a year, you can make that in a month, you can make that in a pay period, right? And you get all 4 credits. Now, to be eligible for Social Security, you have to have at least 40 credits, so about 10 years of earnings history. But what's really important is that Social Security is based on your highest 35 years of earnings. So when you look at your Social Security statement, you go, wow, they're going to give me $2,500 a month. Well, that's based on your highest 35 years of earnings. The more you make, the longer you work, the more your Social Security is going to be, okay? Now, there's this thing called an earnings test. So I'm not going to hit too much on this, but earnings test is important. So let's say that you're going to retire at 62. Actually, scratch that. You're not going to retire. You just want your Social Security, but you're going to keep working. You turn 62 and you say, I want my Social Security, but I'm going to still work until the foreseeable future. That's no problem. You can do that. However, if you're 62 receiving Social Security or any time between your full retirement age and 62, and you're receiving Social Security and you make more than $23,400, they're going to cut your Social Security in half, right? So your 2,000 turned into 1,000 because you made too much money. That's an earnings test or a wage test or means test, all kind of the same thing. Now, let's say that you're going to be 67, your full retirement age this year, and you're making more than 62,160, a third of your Social Security is going to be reduced, right? However, let's say you're 67, your full retirement age today, and you're out there making $250,000 a year, and you're receiving Social Security. There is no more wage testing. You can make that money, and there's no more reduction in your Social Security. So you got to understand the rules and regulations of Social Security. It's really important to know how to maximize this. Now, Social Security taxation is what I was talking about earlier. Social Security is taxed in a few different ways. If you are single or you're married, you can see on the screen the limitations that you have before your Social Security is taxable. So let me give you an example. If you are a single filer and after it's called the provisional income formula, the Social Security tax formula, If after that formula, which is all of your taxable income, half of your Social Security minus standard deduction gives you X, right? And that formula, if you make less than 25,000, there's no tax on your Social Security. It's tax free. If you make between 25,000 and 34,000 as a single filer, up to 50% of your Social Security is a taxable income. If you make more than 34,000, up to 85% is a taxable income. So what does that mean? If you're making $1,000 a month in Social Security and you make more than $34,000 a year, 850 out of the 1,000 is going to go on your tax return the following year as a taxable income. That means you need to start withholding tax from your Social Security. Now, there's a part in Congress right now that's trying to get rid of tax on Social Security. Hasn't fully gone through yet, so as of now, there's still tax on Social Security. And look, if you're married filing jointly, this could be for both you and your spouse, could be taxed up to 85% of your Social Security. So really important. And this is why, you know, at the very end, when you fill out that survey, put down, hey, run my tax numbers, run my Social Security tax so I know what my Social Security tax is going to be so I don't have any surprises, right? You don't want that surprise tax bill at the end of the year, trust me. So let's look at some tax strategies here. This is kind of going, bring it all together. We're on the home stretch here, so bear with me another minute or so here. This is an example of Roth conversion. This is actually a software we use. So in this example, this is somebody that wanted to do Roth conversions. And the great thing is that we put in all their information. We said, you know, this is what their incomes are going to be. This is when they want to retire. This is what their Social Security tax is going to be. But they want to do a Roth conversion and stay in a 22% tax bracket. How much can we convert each year before we get bumped to the next tax bracket? And you can see down to the dollar. So in year one, because we know what the tax brackets are right now, this person can convert $108,058 a year and still stay in the 22% tax bracket. They go $1 over, they go to 24, right? Know the numbers of what's available to you. Now you see a big drop on the second year, well, because they're anticipating the tax brackets changing. Take advantage of what you have in front of you. And look, this person, just by staying in the same tax bracket they're in, are going to pay $37,000 less in taxes from 75 to age 80. And again, these things can be adjusted. I mean, there's so much that can go and be adjusted as we go. But just one simple thing could save over almost $40,000 in taxes. Not a bad deal. All right, now, I want to hit on this RMD thing. It's really important. The required minimum distribution, again, is what the IRS tells you that you're going to be forced to take out at that age 73 or 75. And what happens is, if you get forced to take out more money than you need to, because they're going to add up all of your taxable traditional assets, and they're going to tell you how much you have to take. So if you have $500,000 of assets, they're going to force you to take out just under 20 grand a year. What if you only needed that 12,000 we talked about? Well, guess what? That $8,000 a year, they're going to force you to take it whether you need it or not. That's why things like Roth conversions play a really big role, so you're not taxed on more than you need to. Okay, so again, really important to keep RMDs into the conversation. And here's the breakdown. There's, that's an RMD report right there. $500,000, the required minimum distribution on that would be $19,607. That's a big number if you don't need that money. All right, let's put it all together. I threw a lot at you here, but I want to lay the foundation of planning, right? Be strategic, have a game plan. Look, what are some things you could do today? Maybe make some changes to TSP we just went over, get some advice, break down your real numbers, reduce debt, just get yourself in a position where if you need help, get it. Like I said, in just a short amount of time, it's gonna be a survey that pops up. Fill that survey out. Let us know how we can help you. There's no cost to doing it. We just wanna make sure we help get you the information. Let us know what we can do to help, put it all together, because look, get the report that's gonna show you all these numbers, okay? Put it all together. Put the pieces to the puzzle together. Remember what I said, to work in harmony with each other. So you know what's taxable, what's not, bring it all together. Here's a couple of resources for you. If you have questions, feel free to email info@myfeduniversity.com or call 919-706-1846. Just resources for you to get access to answers that you need. Or once again, fill out the survey that's going to come up. Somebody from the MyFit University team is going to call you, and they're going to answer your questions for you. Okay. So again, thanks for attending this. Hope it's been helpful, and let us know how we can help. We'll see you on the next workshop. Take care.